Ladies and gentlemen, welcome. In our panel, we have a representation of key players in this industry. We have the regulator, who regulates NBFIs, including retirement funds and capital markets. We have asset owner, DPF, second largest pension fund in the country, with an AUM of 12 billion. We also have an asset manager, Thusano Capital, a private equity firm that was awarded 1 billion pula infrastructure mandate by Botswana Public Officers Pension Fund, our largest pension fund in the country that is currently running or with an AUM of about 109 billion pula. We also have our Economist from Econsult. And then lastly, we've got a bank, Absa Bank Botswana, representing the banks, acting as an asset owner. What would you say are the biggest challenges you face when investing in alternative and private markets?
Okay. Thank you for that question, Dimona, Baholo, Botsadi, colleagues, stakeholders. I think the biggest challenge of investing in alternatives is that they are deemed to be a new asset class. The traditional asset classes for investing in the listed space, either listed equities or bonds. Now, infrastructure, in its own nature, if you look at the tenure of an infrastructure investment, you're looking at 30 years or so when the life of the asset class diminishes. It needs to be restored or refurbished every 5 years, every 30 years, depending on the asset class. And when you look at the returns for infrastructure, they aren't as high as your traditional asset classes. If you invested in listed equities, global equities, you can have those good unicorn investments, particularly in the tech space. Your AUM, your assets, your returns can grow by as much as 100%, depending on where you are invested. Infrastructure by its nature is also illiquid. So when you trade infrastructure, you really struggle to find off-takers. So it's not easily tradable. But the benefits of infrastructure is when you're invested, you want to be diversified. More importantly, you want to be intelligently diversified. You want those asset classes with low and negative correlations. They drive the fund. Now, the benefits of infrastructure are multifold. For us as DPF, we were the first institution to invest in private healthcare. We invested in Gaolathe Private Hospital alongside other asset managers such as BIFM. And for us, infrastructure serves an important node. COVID, as an example, really showed us the importance of investing in infrastructure. You couldn't go to Mill Park Hospital, you couldn't fly to Siding Hill, you couldn't go to any other hospital outside Botswana. So there's a need for infrastructure. It has its benefits. Over and beyond the returns from infrastructure, our view is we need to ensure that our members benefit from their life savings. And how do they benefit from these life savings? By being able to access services in Botswana. If you have a pension salary of 20,000 pula a month and you need healthcare and you need to fly to South Africa, if you're earning 20,000 pula a month through your pension and you need to take your kids to school, you only have to access South Africa. Those challenges diminish your earnings as a pensioner. So you need infrastructure as a pension fund. You need infrastructure as an institutional investor to provide those returns and to provide your constituents, your members, with the benefits of those returns. I could argue that if you're earning a pension of 40,000 pula a month and you're accessing all these asset classes, all these services, offshore, then you don't benefit from your salary, which is meant to enable you to live comfortably in retirement. So infrastructure does have its benefits and challenges, but in the greater scheme of things, it's quite important to have in a portfolio. It's an important asset class for the nation, and it's also an important asset class for growth.
Thank you, Mr. Norman. And I kept on seeing Sebonego nodding, so I'll give you the same opportunity as an asset manager. What are you saying? What would you say are your challenges in this space?
Okay, thank you. I think I'll talk to challenges specifically to what we see in the market. I think Thato has touched on the challenges generally about the asset class and opportunities around it. So for us, we are operating just here in Botswana, and we've been around for about a year now. Some of the challenges that we've seen with infrastructure, it's largely around awareness of private infrastructure. So generally, when you think about the history of this country, infrastructure has been delivered by the government. So you find that even now, when there's so much capital flowing back into the market, there has not been a thought through around how that capital can actually be delivered within private infrastructure investments. So that's number one. And the result of that lack of awareness is that there's no space, essentially, for private participants like ourselves. So we spend quite a lot of time engaging with the other stakeholders, largely the ministry, on how to create that space. As an example, I think most of you will be aware of the 100 megawatt solar project by Scatec in Madinare. If you look at the conditions for that project, the requirement for local participation, as in selling to a local company, is only after 4 years, right? From project development until that period, the guys can just operate without any local shareholder. So these are some of the engagements that we've had with the ministry. There's new tenders that came out last Friday, so we'll see if they've made that adjustment. Then this other challenge that we see, it's the long project development cycle. Largely due to, again, it's a new area, even from the power side, the independent power producers, it's a fairly new concept in the country. The impact of that is that to develop a project takes just too long, especially for areas around permitting. Environmental permits take quite a bit. A lot of the land, obviously, it's agricultural land that needs to be transformed. That change of land use takes time. And also the licensing itself, because you need a generation license from BERA. So these are some of the challenges. But linked to that, you find that you actually don't have a one-stop place to go to. So you're going to, if you have two projects, you'll be, let's say, somewhere in the Gaolathe area, and then another project, let's say, somewhere in the Sebonego area. You have to be shuttling between these two areas, talking to the different councils to get your permitting. Whereas where IPP programs have been very successful, you find that they do have just the one-stop shop to go to, and you can get all the support to develop your projects. The other challenge, obviously, it's a new area in Botswana. We don't have a lot of experienced developers from a project development standpoint, from an infrastructure standpoint, because sometimes project development, people think real estate, but the project development for infrastructure is actually quite, it requires a lot of skill, and it's quite specialized. Because it's still new, because most of the projects we've had in this market have been very small, we have not developed that capacity. But it is encouraging that we're seeing very big projects coming into the market. I think we have 900 megawatts of solar that were released this past Friday, which each one of them, I think it's about 250, 200 megawatts. So we expect those to attract experienced developers who obviously, hopefully, or do skills transfer Then the last part I'll speak to is that, you know, in projects, there's always this component of local components. And we find that funding is actually not part of that. They'll talk about you need to procure from local guys, you need to local contractors, et cetera, et cetera. But nothing around requiring to actually source local funding. So I think it's something that we've actually engaged quite a lot with the government around it, because for us, we see it actually as a big risk if you're going to fund infrastructure with foreign currency, because these are very long-term projects, and you know what happens, the exposure from a currency standpoint. So that I'd say are the challenges. I don't know if you want me to talk about some of the opportunities we're seeing, or I can talk about it later.
You can talk about
Okay.
it later.
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 Okay,
Yes,
cool, thanks.
yes. It's clearly we need to start somewhere, as it's a field that is evolving, and patience will also be needed. I believe Ben Hakudisang did demonstrate that private equity market, when tapped, it can actually help diversify the economy, which is what is key right now. I'll move on to Dr. Jefferis. As an economist, we would like to hear your views. Can you provide a macroeconomic and public finance perspective on the need for alternative investments to drive the growth?
Sure. I think there's many angles to that. One is that our economic environment has changed a lot over the past decade. If you go back several years, we had very high savings rates, much higher savings rates than investment rates. There was a lot of savings around in the economy. We were running balance of payment surpluses. And government, of course, was part of that situation. It had very high fiscal revenues, running budget surpluses, to put it bluntly, more money than it knew what to do with. And of course, in that situation, as government, you can finance a lot of infrastructure projects very easily without having to go to the market or to the private sector to get financing. And I think my former boss is here, Dr. Mandlebe, but I don't think he'll mind me saying that a lot of the project management and implementation by government, when there was plenty of money available, was not very good. Quite inefficient. Projects were not necessarily well selected or prioritized. And I think all of those situations have changed. So now we're running balance of payments deficits. We have much lower levels of national savings, and government itself is running budget deficits and does not have the money that it used to have to fund development programs and development projects. So I know my colleagues have talked about quite a lot about, Thato talked about the private hospital, and Oteng's talked about private power generation projects, but most infrastructure projects are public. That's what governments do. They provide or incentivize the provision of infrastructure, and they're in the lead. And I think, historically, our government has provided infrastructure and paid for it. From a macroeconomic perspective, that's no longer possible. But we still need infrastructure. And so if we are going to develop further infrastructure projects, we need to bring in private savings to complement the public savings and public revenues that are financing those projects. And the whole environment has changed. We can no longer expect government to be the sole or primary provider of public infrastructure. We have to have private investors coming into those projects. Although our overall national savings rates are dropping, at the same time, where those savings are held is changing. We do have an awful lot of savings held in the pension funds. And those savings are looking for diversified avenues for investment. So the whole environment is changing. But what it requires is those public or broadly public infrastructure projects have to be structured in such a way that private finance can be part of the picture. You know, it's not the old days where a spending ministry, first prize would be, get my project in the budget. And once my project's in the budget, I go ahead and implement as government. Those days are gone. But if we're bringing in private sector finance into these public infrastructure projects, they've got to be structured very differently. And I think that's where a bit where we're lagging is we haven't yet adjusted to that new reality. Thanks.
Thank you, Keith. I will go back to you, Thato, as an asset owner. How do you then balance the responsibility of ensuring the long-term returns of beneficiaries with the need to support national economic growth through infrastructure investment?
I think the idea has convergence. As asset owners, you want the economy to grow. The economy can grow better in the event that productivity levels increase. If you have a better road infrastructure, you enable better trade. If you have increased or stable power infrastructure, you increase productivity from a manufacturing perspective. So the two are actually complementary to each other. From the infrastructure projects that you've done, you face construction risk. The fund, our fund, we are only 12 employees. We don't have the capacity to support in a road project. Nonetheless, we have the capacity to appoint infrastructure funds in Botswana, which have been recently set up to assist us with that need. And we also need, in building infrastructure here, we need to also be cohesive in the way we look at infrastructure in Botswana. If there's strong infrastructure in South Africa, there's strong infrastructure in Namibia, Zimbabwe, our trading partners, we benefit as an economy. If we share power with South Africa, we share our rail network with Namibia, South Africa, we benefit. Just for context, for every 1 percentage point growth in South Africa's economy, Botswana benefits by as much as 0.5%. So we're alive to the need for improved infrastructure. If you have the right infrastructure, you will attract the right citizens and immigrants in your economy. You know, the Vice President mentioned Canada earlier on, and Canada has a fantastic strategy. They've said, we want to target 100 million people in 100 years. Because they've found the benefits of the human skills and human capabilities in driving economies. So I think from our end, we're totally aligned from an infrastructure lens. We need to collaborate. The more the DFIs, the more the global financial and development institutions participating in one project, the easier it is. Because if you look at the ticket size, we are only 12 billion. 10% of 12 billion is 1.2 billion. What can it do from an infrastructure lens? If you're looking at building a significant road network, you need large amounts of infrastructure. But I think partnering with Absa, partnering with BPOPF, partnering with government will create an enabling environment for us to deploy some of these resources to these infrastructure needs.
Well said, Thato. I like the way you closed it on how best we can partner, and also including BPOPF and the partnership to say, what would 1% of your 12 billion really do at the end of the day? Thank you. I'll move on to you, Doctor. In the regulatory space, what specific regulatory frameworks are currently in place to promote economic growth through alternative and private investments?
Thank you, Botho, and good evening to all of us in the room. It's a pleasure for us as NBFIRA to be in this meeting and to be, networking with the rest of the industry. As the regulator, we play a major role in basically opening the door for the playground, and the players in there. I start there because as the regulator, we are empowered by our act or by our legal instrument, specifically the Securities Act 2014, amendment of 2023, to license asset managers specializing in private equity. So licensing of these players is very key because just like any other licensed and regulated entity or player in the market, this means that the regulator therefore is responsible to ensure that this market plays in a safe and a sound environment. The entities that are playing in that space, they should remain safe and sound for the investors to trust investing in that space. Licensing them also means that the regulator will ensure through its regulatory instrument that that market is secure, as in like market misconduct are actually guarded against. And therefore this provides a safe space for the investors. Measure also to our regulatory space or assignment is that we license and regulate and supervise to ensure that the market is actually stable. The product that we're talking about, the investors, the potential investors, most of the time, they are big entities and they've got a possibility of having systemic risk if not wisely guarded against. And systemic risk, can destabilize the financial market itself and the larger economy. Therefore, we regulate, supervise for stability purposes. Having said that, this far we have regulated about 6 private equity fund managers as NBFIRA. And we commend this, given that this is a new area, and that 6, we don't take it for granted. And we're looking forward to license more in this space. I would want to also say, as NBFIRA, our observation is that investment around private equity is not only set aside for pension funding. Our observation is that there is interest even from the broader financial market, in the sense that even the insurers have got interest in there. We've got professional investors also who are interested in there. So we do have regulatory instruments that guide each sector on how much, basically the limits of investment in the private equity. Take the PFR2 that has been talked to most of the time in this meeting. PFR2 allows for alternative investment limit of 25% of the pension funds. So this one is to do specifically with the pension funds. Within the alternative investment criteria, that 25% is further divided into your hedge funds, allocated maximum limit of 5%, private equity 10%, local private equity 10%, and offshore private equity 5%, and then you've got the local infrastructure class allocated 5%. This PFR2 have some developments in that it increased the private equity from 5% to 10%. This is the regulation admitting that we can actually increase scope and allow more investment in this particular class. Of interest also is that local infrastructure class, which has not been there before, but through regulation it has been put in there. This shows the flexibility of our regulatory frameworks. But having said that, there is also what a limitation or a limit that had been put in our PFR2 to do with unlisted shares. This also promotes investment in the private space, and that allows for a maximum of 20% of the investment in that space. But when you look at the prudential regulations for insurance, like I said, it's not only on pension funds, but also insurance. The prudential regulation for insurance allows for unlisted shares investment maximum of 20% of the net liabilities and plus the PCT or prescribed capital. This is to do with the general insurance. But when you get to the life insurance, the prudential rules, they allow for 5% maximum in investment into unlisted shares also. So there is that space that promotes diversification in this asset class. Having said that, I want to hasten to speak to our data because it's a guiding principle also to us as the regulator, even to the market itself. We look at the trend in investment in private equity. What we are seeing is that there is commitment that have been made towards these funds of about by December 2024, with about 3 billion committed for PE or private equity, December 2024. This is a rise, a huge increase from what we noted in 2021. We had only 510 million commitment in 2021. So you can see the growth from 510 million in 2021 to 3 billion as of December 2024. Having said that, we are seeing the drawdown from this commitment. As of December 2024, we only had 600 million. Commitment of 3 billion, investment or the drawdowns are at 600 million. So you can see the gap, and that can be explained by the asset managers themselves. They're better placed. But otherwise, in 2021, that investment was standing, or the drawdowns were around 260 million. So we also are seeing growth in the investment space from 260 million in 2021 to the 600 million that we are observing today. However, there is still that gap between what was committed and what has actually been drawn down. I would love to stop here for a while. Thank you.
Yes, thank you. And I must say, indeed, we are noticing that growth. I think you onboarded, was it 3 more firms last year, the likes of Thusano Capital. And again, I would like to believe that indeed you are creating an enabling environment for the players, because when I asked them of the challenges, none of them did mention the regulator. I guess you're doing well. Okay. Dr. Keith, what sectors within the alternative or the private markets do you believe have the greatest potential for economic growth or economic impact?
If we talk about economic growth broadly, I think that a lot of different sectors have potential, whether it be manufacturing. There's a lot of talk about energy, digital services, tourism. I think that we've seen successes across all of those sectors, and I'll be honest, most of those are going to be driven by the private sector, and are not necessarily what one might class as alternative investments. I think a lot of them are more conventional investments. If we're looking at sectors where there's opportunities for, say, infrastructure investment, which I think is a lot of what we're focusing on today, then I think really anywhere where infrastructure is required is potentially investable, but under different circumstances. So there's been a lot of talk about energy infrastructure, and that in a way is quite easy. And the energy projects that have gone forward so far, say with BPC's IPP program, to be honest, they've had no problem raising finance. They're easy to finance. Things may change as we ramp up, but energy projects, IPP energy projects, are not finding any problem getting financing. I think it gets more difficult, and so one reason it's easy is they've got a guaranteed revenue stream. And any project that's got a guaranteed revenue stream is pretty easy to finance, subject to some other conditions. I think the issues around other types of infrastructure, whether we're looking at water, transport infrastructure, other public hospitals, public healthcare, public infrastructure, they become more challenging because they don't have guaranteed revenue streams that are sufficient to cover the private sector financing costs. And so while they're potentially financeable through private infrastructure investments, I think it has to be done very carefully. And if we're looking at constraints to that type of private investment, I agree. I don't think it's regulatory constraints, and I don't think it's availability of funding constraints. There's plenty of funding looking for infrastructure investments. It's more about if I'm an asset manager, if I wear someone else's hat, if I'm an asset manager or a pension fund manager and I've got money to invest in infrastructure, the issue is, what do I buy? I've got $1 billion pooler, what do I buy? At the moment, there's almost nothing. Apart from BPC's IPPs, there's nothing. So I think the constraint and what needs to be looked at is actually developing a pipeline of investable instruments that will be suitable for the needs of the institutional investors. And it's not all that easy. It's, as I say, in energy projects, it's okay, but as soon as you get to other projects which are unlikely to generate a fully commercial return, and there we're talking about most transport projects, a lot of water projects, and certainly public education and healthcare, they don't in themselves generate a commercial return. So then we have to look at what's the relationship between the private financier and the government, which still underpins these projects. So what's going to be the role of government in providing part of the financing and taking on part of the risk, and how's the risk going to be shared between the private sector and government? So I think there's a lot of sectors that have potential for bringing in private finance, but they're not easy. These things are not easy, especially the first ones. Once you've done one or two, it becomes much easier. But the first ones are not easy, and a lot of thought has to go into how can public infrastructure projects be structured in such a way that makes them attractive to the private finance that's there.
Yeah, I see there is really a need for all these to be well structured. And I know yesterday you did ask me a good question to say in the panel, who is the government?
Yeah.
That I've noted that. But this is not the first and last engagement, so we will have the government. Oti, in your space, what would you say, having listened to what you said?
Yeah, I think generally speaking, I largely agree with Keith. But for us, because this is all we do, so we've actually been able to see some opportunities. I think energy, I won't touch to it. Keith has spoken to it. We've seen a lot of IPPs, but there's still opportunity for battery storage because we don't have any battery systems on our grid at the moment. There's also opportunities for grid expansion. Actually, we're going to have to do grid expansion if we are to reach 8 gigawatts. Because if you think about how our grid is configured, there's a lot of opportunity to put up more grid capacity in the southwestern side of the country. We see quite a bit of opportunity also within the digital infrastructure space, largely data centers. I think if you think about tiered or rated data centers in Botswana, most of them are actually, all of them for that matter, are in the Greater Gaborone region. So we see opportunity to build redundancy data centers. And also we see opportunity to actually equip some of the existing data centers with cloud technologies where you can actually host processing services for some of the large technology companies. Another thing that I think it's interesting to note, speaking of just data centers, there's a massive Terraco data center in Midrand, and there's a line that's actually built as redundancy fiber line going through Botswana by apparatus. And the people at apparatus were telling us that day that actually data travels faster through that line instead of going through Cape Town, even though there's the redundancy line. So what it indicates, because as you remember, there's a Google cable in Namibia and Melvis Bay, so that's what they're connecting to. So there's also an opportunity where you could actually, again, if let's say you do expand your grid to the southwest side, you could actually build hyperscale data centers potentially using solar energy, which is obviously quite a big deal because there's a lot of concerns around energy consumption of data centers. So we see opportunities in that. The last one where, which we think actually should be a low-hanging fruit, it's around transport and logistics. One thing that I sense we don't appreciate in Botswana is the impact of the Kazungula Bridge from a logistical standpoint. We only see the inconvenience it creates when trucks come to Gaborone instead of going through Martin's Drift. But the reality of it is that it has actually opened up trade between mostly Southern Africa, but I have seen trucks from as far as Mombasa and the roads here in Gaborone. Now, what can be done? There's two things that we think we see as an opportunity. Number one is to actually build a similar bridge in Martin's Drift, single border post, a toll bridge. And I think if it's a toll, it makes it very attractive for private participants like ourselves. Then the last layer to that is that, we now need to build the road infrastructure to take that volume of trucks, similar to what we did with the Trans-Kalahari Highway. So it's something that we've done before, connecting the western part to Namibia. Now we have an opportunity to connect into Zambia all the way to Kenya. So I think half of that work has been done, and there's a bit that needs to be done. And I think companies or pension funds and partners like yourselves can participate to bring that to reality. Thanks.
Thank you so much. Great insights indeed. And my dear panelists, I would like us now to manage our time. Going to you, Tebogo, from the bank point of view, how can banks collaborate with asset managers, pension funds, asset owners to create investment vehicles that directly contribute to the development of Botswana's infrastructure?
Thanks, Botho. I think from our perspective, and probably just to give a brief background on who we have in the room, because for us, collaboration is not purely from, just pension funds, the regulator, and equally even Botswana government, but some of the entrepreneurs that we have, where, private investment starts small, in comparison to some of the very large infrastructure projects that we tend to want to look to, is where we want to collaborate. For the most part, our biggest, I don't want to say challenge, but probably our biggest learning when it comes to infrastructure projects has been the ability to tap into the tenures or the deep capital requirements, and also most importantly, the extent to which, equity funding at that point is a significant requirement. And collaboration really for us is where we are able to participate in funding where we see that the pension fund is also willing to come on board, but also most importantly to identify very soft industries beyond, your general public industries that are led by government, such as education, an area where in this country, when we look at the level of universities and the extent to which they can generate income for the country, I think BOOST teaches us a very good example of what we can do, but most importantly, it's not topical because there's a lot more focus on other aspects such as renewable energy. But I think for us, when we look at the clients that we have, when we look at the various sectors that we bank, and equally in the room, we have various sectors that are looking for different types of investment at different stages, and that is the collaboration that we'd like to provide. Speaking specifically to private equity, when we look at general partners, and I think we fully understand the structure of PE, the extent to which, the funding is limited to a certain point in terms of funding, where the expectation is that it sort of takes a different turn, or the PE eventually comes out of the structure. We are looking at those aspects, of providing that level of liquidation in the structure to just make sure that you are able to not get to a point where investors need to minimize or take out their asset, to just make sure that they continue to drive value creation. I think lastly also is really to speak to just the overall returns. I think that's been spoken of. I think Thato mentioned it. When it comes to large infrastructure projects, the returns are minimal. It takes a long period of time. But also just the lessons that we get to learn when you look at very soft aspects of development, where the returns actually are quite reasonable and in a short space of time in comparison to a very long-term structure like infrastructure. So from a collaborative perspective, I think firstly, Botho, is just to share a lot more information, sectors that we are exposed to. Absa is a big group, as we have some of our colleagues joining us from the group who have a view of various countries as well. And also, most importantly, to recognize that there's value in when a pension fund is looking for an investment vehicle. We in the room also have a client who is saying, I'm looking for an investor in my business, and how do we sort of bridge, that gap? Thanks.
Thank you so much, Tebogo. This one will go to all. We've been talking a lot, and Keith, we've been talking a lot about structuring all this. Now, how can public sector infrastructure investment projects be best structured in your views to facilitate this market?
Should I go first, since I started?
You can go first.
Look, the answer, not very helpfully, is it depends. And it depends a lot on the nature of the project and the sector. So, as I said earlier, projects which have a revenue stream which can cover or make a big contribution to covering the capital and ongoing financing costs, I think are easier to structure. But overall, apart from the ones which can be purely done on a self-contained basis, like the power projects, and there would include things like the transmission grid, etc., and the battery storage as mentioned. It's about, firstly, the arrangement between the public sector party and the private sector party. So if we look at something, I'm taking a risk talking about the Gautrain because we've got some much more experienced people here. But if you look at the Gautrain, which was a PPP, the Gauteng government contributed a big chunk of the capital costs. And it provides guarantees that underpin the revenue. So there's a minimum ridership guarantee. And as in COVID, if it doesn't reach the projected levels, government has to step in to underpin. So it's about the sharing of the costs and the risks between the public sector and the private sector. And that will vary a lot depending on the nature of the project and its risk profile and its revenue profile and its cost profile, etc. And then, so that's one discussion. The other is looking at different financing tranches. So you're going to have some financiers which are going to be mostly interested in a loan type finance for an infrastructure project without taking too much risk. But others will be happier with an equity type investment, and there's all sorts of in-between things which can be done as well. So it's about looking at the the structuring of the sharing of risk between the public sector and the private sector, and how on the financing side, the overall financing requirements can be best structured to meet the different needs of the different providers of finance.
Yeah. And then I'll give you just 2 seconds, Dr. Mmolainyane, your views.
Thank you, Botho. Following on what Dr. Keith had just talked to, I think for Botswana really it's time for us to move into solid triple Ps, and that are well thought of, like what you were saying. But also it's an area where we need expertise, because triple Ps in themselves can be divided into economic triple Ps, which can generate funds and repay. But we also can have social triple Ps, where you offer social services to the larger population of Botswana. So it depends on how we structure and model our triple P so that we achieve what we want to achieve, and also maximizing on this kind of asset classes.
Thato?
For me, I'd say we need to create a conducive environment for investors. The legislative framework needs to be supportive. We also need to be more efficient, where we can aggregate some of the approvals for these projects. We also need expertise, and it could come through experienced partners who've done these initiatives before. I think, just to take you back, if you look at our pension fund assets in Botswana, and I shared this yesterday, our assets are worth about 160 billion pula for 2.5 million people. And just for context, if you go to East Africa, Kenya has about 60 million people, and they also have about 180 billion in assets, or 200 billion in assets. So Botswana has had such a rich legislative framework, and the institutions have assisted us in attaining this high income status or middle income status. So I think for us now is to, as funds come back in, as the regulator says, 50% of the assets should be onshore. We should come up with those initiatives. And from where we sit, we also say private equity funds, some are mature, some are being incubated. So they also need to exit some of these investments for them to have the deal experience, so that we can support them. But for me, I just think we need to create an enabling environment. And once that enabling environment is available, and once we have a platform in which businesses can thrive, I think infrastructure, partnering, and attracting the right capital will be much, much easier.
Thank you. A second.
Yeah, I think Thato pretty much has taken my words, but I think the big thing is, that enabling environment is largely around de-risking the project to a point where it becomes attractive for a private investor. I think the other part, slightly different, it's around how the project itself is presented. And I think Keith touched on it, that energy is largely easy because these are standalone generation assets. But similar to, I think, Gautrain, it's a concession, right? I think if the government was to, let's say for this example I gave for the northern trade route, if they were to give a concession for that construction of that road, and actually can start charging for it, or even adopt a model where they get to pay for the road being made available as a public use. So I think that also could help. Thanks.
Largely have been covered. I think mine really is very similar to our NBFIRA counterpart. I think it really is largely around the legal framework, the ability for government to also recognize that it's important to let go of, the fraternity of wanting to manage each and every infrastructure project to a point where even private private participation can actually eventually enable them to thrive in benefiting or realizing value. That's all from my end.
Thank you so much. Ladies and gentlemen, due to time, please allow me to ask for just 3 questions on the floor, being directed to our panelists here. And when you ask a question, kindly also indicate the question and the panelist you are directing that question to. Mics, please. I see a hand there. Okay.
So should I stand?
You may.
All right.
Yes. And
hi-
introduce yourself also.
Yes, hello. My name is Lesang Mahang. I'm from Pakalani States. I didn't want to be the first person to ask the question. And just to comment on Mr. Seake from Absa, on the current climate that we're in globally, is I've just got 3 statements, or one is a question and 2 is statements. There are infrastructure projects that are out there that the private sector can be involved in, that pension funds that have long-term patient funding can come in to answer all your questions, Sebonego. I'll meet you after this dinner. We're talking about the social return, that the social return for pension funds is not just the financial, but also the social return. A lot of people who are reaching the ages of 65, 70, 75, who are
Spent all my life holding all of it closely. I played it innocent, a feel of discontent. I'm finally facing it all, fearless.